From the nation's capital in Washington, D.C., the Congressional Report, with your host, Iowa Congressman Tom Latham.
This country is based on farms, on small businesses, and creating jobs and opportunities. That is the lifeblood of this nation.
And now your host, Congressman Tom Latham.
Hello and welcome to the Congressional Report. Congress passed a $700 billion bailout of Wall Street, known as the Troubled Asset Relief Program, to shore up the financial system during the economic crisis in 2008. Since then, Wall Street has largely bounced back from the crisis, while Main Street has seen much slower recovery. This situation has left many Americans questioning why the government rushed to bail out the financial institutions that contributed to the downturn with hundreds of billions of tax dollars. Joining me today to discuss the TARP is Mark Calabria of the Cato Institute. And Mark, welcome to the Congressional Report, and tell us a little bit about yourself and about the Cato Institute. What do you guys do?
I'm glad to be here, and we are a nonpartisan think tank. We have about 100 staff, of which about half are scholars who work in various policy areas. We largely come from what is sort of a libertarian perspective. I mean, our tagline is limited government, freedom and peace, and those are the things we all work toward at Cato. I do all of our financial services stuff, which covers securities markets, covers banking, covers topics of the broad spectrum. Also do mortgage finance stuff. Only been there about a year because after I spent about 7 years up here in the other body, working on the Senate Banking Committee, mostly for Senator Shelby of Alabama, is where I cut my teeth on learning many of these issues. Also, I've worked a couple of industry trade associations, worked in the National Association of Home Builders, National Association of Realtors, doing economic forecasting. So haven't been doing any actual model running lately, but had a couple of years doing some forecasting and keep my pulse on the economy constantly.
Very good. Just step back. I mean, we talk about the $700 billion TARP bill, the bailout. Why did we need that? What happened? What brought us to that point of crisis?
Well, I think a variety of things brought us to that point of the crisis. Probably foremost is we had a massive speculative bubble in housing. I mean, we also had speculative bubbles in a variety of other assets, but the primary driver of this was housing, and you had mortgage-backed securities, both private label, but Fannie and Freddie throughout the financial system. And once the housing market turned, there is really just vast uncertainty over who has these assets, even more importantly, how much they are worth. So the solvency of lots of institutions, whether it was investment banks, whether it's commercial banks, whether it was Freddie and Fannie, were all called into question. The TARP came about really from pressure both from Ben Bernanke and then Secretary Paulson of the Treasury to kind of find a way to get around doing what were just ad hoc Sunday night, decisions on companies that the Federal Reserve was stepping in. I mean, you had the rescue of the assisted purchase, should I say, of Bear Stearns to J.P. Morgan, and you had the rescue of AIG. And these were all things that, it's hard to look at and say what was the rhyme and reason that were really made up as they went along. And so Bernanke and Paulson brought the TARP to Congress as a solution to, okay, now we know what we're going to do to save our economy. We're going to buy troubled assets, hence the name. Of course, it's very interesting that not long after the bill finally got through Congress, as it failed the first time around in the House. When it finally got through, the decision was made by Secretary Paulson to do something completely different with it. It's interesting to note that we have yet to buy any troubled assets under the TARP. We've been doing equity purchases in banks. We've been doing equity purchases in the auto companies. We continue to purchase in AIG. So it really was the financial echo of the uncertainty that came about from the turning of the housing market that really kind of caused and pushed the need, the reputed need for the TARP.
And today, Wall Street has pretty much stabilized. There's a lot of these companies that were in trouble then are making sizable profits today. Looking back, was it a mistake to have the TARP?
I think it was a mistake. I mean, I'm certainly willing to say, as an economist, some of these things are hard to definitely prove, otherwise. I think if you start with what we know, for instance, we know we had a housing bubble. There was very little we could have done, for instance, that would have stopped 2 million construction workers from losing their jobs and being needed to be transitioned into other sectors of the economy. You had another million or so people doing real estate brokerage, mortgage finance, things like this. So, my back of the envelope is we were probably looking at 5 to 6 million of the job losses, the 7 to 8 that we're going to see, would have happened regardless of what we had done to Wall Street. So we should have been focusing on how do we create new jobs for those jobs that are being lost. There were very few actual jobs that were lost. I mean, sure, there were very high dollar jobs that were lost on Wall Street. But the point is that we had an economic imbalance that was going to wind its way through the system whether or not we bailed out Wall Street.
Yeah, I voted against it. And one of the major reasons was that this was simply a check to the Secretary of the Treasury for $700 billion with no constraints. Basically, he could spend it any way he wanted to, and like you mentioned, that it was supposed to go to troubled assets, but that never happened. How was it spent?
Well, most of it was spent buying bank capital. We made preferred share injections into some of the largest banks. We also made lots of preferred share injections into small community banks as well. The very largest segments of it went to the auto companies and went to AIG. So very large part of it, particularly the largest part of the losses, because it's important to look at that most of Wall Street has paid us back. That doesn't make the program the right thing they've done, but most of them have paid us back. The ones who haven't paid us back are the autos and AIG, and in all likelihood, particularly with the autos, the vast majority of the losses that will come to the taxpayer. And the estimates that are out there now is we're going to maybe see 100 to 120 billion of the TARP that's just not going to come back to us, and most of that are the auto companies. Now, I think it's worth noting as well that the TARP bailout is something different and aside from Fannie and Freddie, and we will probably spend 3 to 4, maybe as much as 500 billion bailing out Freddie and Fannie, none of which we will get back.
We'll get back, right? I mean,
that's all gone.
What would have happened if there hadn't been a TARP?
I think one thing you have to parse out too is that I think that when the President Bush and Secretary Paulson, and particularly Chairman Bernanke, came to Congress and came to the American public and said, you need to pass this thing or we won't have an economy on Monday. And Ben Bernanke did come to leadership in Congress and essentially say those words. If people weren't paying attention before, they were paying attention now. And I think to some extent you really set off a panic. I'll go back to my previous point, which is, had we not passed the TARP, we still would have seen 5 to 6 million job losses, irregardless. I think we would have seen less panic. We certainly would have seen more of an adjustment and more losses taken in the financial sector. At the end of the day, the problem is that you had close to probably $2 trillion in losses in the financial system that somebody was going to have to take. And, to me, the ultimate question comes down to, well, after you wipe out the shareholders, should the debt holders in these institutions or should the taxpayer take these losses? And to some extent, the decision has been made that the taxpayer is going to take some of those losses.
So they were too big to fail? Or
in many instances, that was what was presented. I think that previous to the financial crisis, nobody would have said that Bear Stearns was large enough to need a bailout. They were a fairly small institution in the scheme of things. They were certainly smaller than Lehman. AIG was not even a bank. They certainly at the holding company level they owned a thrift, a savings loan, but that was a very small part of their balance sheet. I think the only institutions you really could have made an argument for that we almost had no choice, I mean, as much as it pains me to say this, are probably Fannie and Freddie. Right. And the reasons why, because they were so dug in throughout the rest of the system. For instance, a lot was made that after Lehman failed, Primary Reserve, which is a money market mutual fund, broke the buck, which rose some concerns that there would be a run essentially on money market mutual funds. Well, about 40% of the holdings of money market mutual funds are Freddie and Fannie short-term debt. So if we had not bailed out Freddie and Fannie, 95% of the mutual funds in this country would have broke the buck. Now, that's not necessarily, in my opinion, the end of the world. Even if you had to mark down a mutual fund to 95 cents on the dollar, you still have 95 cents on the dollar. Just as importantly, kind of touching back on the TARP, a number of banks, particularly smaller community banks, came to the TARP saying they needed TARP money because they held preferred shares in Fannie and Freddie, and that their preferred shares had lost value, so they needed to be bailed out. Well, before the crisis, commercial bank holdings of Freddie and Fannie securities represented over 150% of the capital of insured banks. So essentially, if you had had a pretty large losses from Freddie and Fannie, much of the commercial banking sector would have been wiped out. And the really tragic thing about this is, because I remember being on the banking committee at the time, 2003, 2004, raising these issues with the bank regulators. And they thought it was all not a big deal. They were like, it's Freddie and Fannie, they're basically safe. So much of this, the regulatory community was aware of. I don't think that they put all the pieces together, clearly not. But unfortunately, the way our system was set up is we essentially treated Freddie and Fannie as they were treasuries. I think it's also worth focusing on that much of the decision to rescue Freddie and Fannie was as much a foreign policy decision. One of the first things that Secretary Paulson did was fly to China and say to the Chinese, the over $2 trillion you have in Freddie and Fannie securities, the taxpayer will back up. So there was really a very strong decision made that the American taxpayer would take a hit that otherwise the Chinese central bank would take. I think it's particularly painful in that so much of these accumulation of Freddie and Fannie reserves and treasury reserves by the Chinese was an attempt to depress their currency to make themselves, their manufacturing, competitive with our manufacturing. So in some sense, the American taxpayer has taken a double hit. We've had to compete with depressed currency, and now because of that, we've had to actually bail out the mechanism that was used to depress the currency. And I think it's unfortunate that those decisions were never really debated in public. And I think that that's an important distinction to make, in that I think the TARP was absolutely the wrong decision, and I felt very proud working for Senator Shelby at the time that he led a lot of the opposition in the Senate to it. But the TARP was voted on. Right. If you look at what the Fed has done, the Federal Reserve has, to me, you've had literally 5 guys around a table deciding to spend $2 trillion, unelected bureaucrats. Even if they made all of the right decisions, there's something, to me, that's a little unsettling about that's a lack of accountability. I think the Fed has gone over and basically taken a lot of what is essentially fiscal policy, that is to preserve of Congress and not the preserve of the Federal Reserve, and has lost a lot of that accountability and transparency you get with the budget process. And it's not to say the budget process doesn't have problems, but you're an elected representative, you're accountable. These guys aren't.
Well, and taxpayers are liable for every dollar that's, whether it's through the Fed or whether it's through Treasury, it doesn't matter. Going to your part of talking about the loss of capital that many of the banks held, that was an approved capital asset to have Freddie, Fannie shares in their banks for the capital needs, and wiped out, as far as community banks, about $15 billion of assets just overnight when they went away. And I asked Secretary Paulson at the time, and one reason I voted against the bill was because I said, you seem to only care about Wall Street here, and you don't care about that bank on Main Street that has just lost. A lot of my small banks would lose $1, $2, $3 million, not even be able to deduct that against their earnings because it was a capital asset rather than earning asset. We changed that law so they could actually deduct it, but at the time I thought it was he wasn't listening very well. And then they changed the whole purpose. Did he have the authority to do that?
I don't really think that he did. You can read into it where the language was so vaguely written. And I would say, I do think as an aside, a constitutional issue, so much of things get delegated to the executive branch. But this is a delegation beyond, I think, anything I've ever seen in terms of Congress essentially giving the authority to any agency of the government to do whatever. So clearly, the decision to buy capital, they decided that those were financial troubled instruments. Now, people don't generally think of equity as a troubled instrument in the same way that debt is. So I think it's a creative and imaginative reading of the statute that Treasury took, and clearly the bailouts of the auditors were the same way. I do think, going back to another point, it's interesting in that the whole design of the TARP of buying toxic assets only really works for Wall Street banks for the reason that they are mark-to-market institutions. And mark-to-market is you have to readjust your assets every day. Most commercial banks, whether it's you could take even the large ones. Bank of America, only about 25% of its portfolio is mark-to-market, whereas, say, Goldman, they're looking at 85% of their portfolio is mark-to-market. You look at community banks, it's almost 90, 100%.
Right.
So you're carrying these things to maturity. It's an asset you hold in your books. And the problem with that is that the whole thinking was that the TARP would go in there and bid for these assets, and that these were really worth 40 cents on the dollar, and they'd come and pay 60. But if the bank, non-Wall Street banks, but commercial and community banks who are carrying them at 80 or 90 cents on the dollar, they were never going to sell it at 50. Right. So it was a scheme that never was going to ever work for commercial banks. And one has to wonder, either did Hank Paulson believe that all of the banking sector just simply looks like and works like Goldman, or did he plan it that way?
And it's interesting, so many of the people at Treasury then and today all came from Goldman.
And I think it's a degree to which that's their experience with the financial sector. And I think it's important at Treasury and other parts of government to get community bankers and to get people who actually have run industry. I thought, for instance, though he was kind of below the radar screen for a while, when John Snow was Treasury Secretary, ran a transportation company.
Right.
It's hard to think of an industry in which you have yourself more on the pulse of the economy than transportation. And he had a very good sense of the economy in a different way than Paulson did. And I think Paulson saw things through, the lens of Wall Street. And so I don't buy into as much of that it was a conspiracy. I buy into those were his biases, those are the lessons he's learned, and that's how he sees the world.
He really didn't seem to care at all about Main Street. It was all about Wall Street at the time. How much of the TARP money has been spent? What's out there yet?
We've spent about close to 500 of the 700 billion that was total. We've gotten a little bit more, maybe about 150, 160 billion back
again.
So how much you've gotten, there's some debate over the reading of the law whether the Treasury can respend as they get paid back. There's a separate issue. We've gotten about 13 billion in dividend payments back from the banks, and we've gotten about another 7 in the warrants that were held out, were auctioned off. So you have a little less than 20 billion that the consensus seems to be that the Treasury cannot just simply respend or recycle. But there is about 260 out there that the Treasury takes the opinion, and granted, they've actually said different things. They've at one moment said, we can't respend that, it has to go back to pay the deficit. And then they've other times, Secretary Geithner has gone out and said, and completely contradicted himself and said, well, we can spend what we get back. So there is some ambiguity there, but there is essentially about 260 billion that is sitting there that potentially could be spent, and I think is constant danger of being respent by some in Congress who have lots of ideals to spend it on.
And people here have been talking about that as kind of a piggy bank to spend on other things. The fact of the matter is, once it's paid back, then we just don't have to borrow that much more, and there's no money sitting there.
Exactly.
This is anything we spend has got to be borrowed, even if it was, quote, out of the TARP that's been paid back or whatever.
And that's 100% right. Whatever we spend it on, we would be simply adding to the deficit again. So I think that's, and there really is no difference between if you just appropriate the money and spend it without paying for it, and if you take it out of the TARP, it's essentially the same thing at the end of the day.
Well, AIG had the credit default swaps, and this apparently was a small office over in London, I think, where they got them. It generated about 25% of their income with about 20 employees over there. And that really, explain what that is and how that all went upside down.
I'll start with the basics. I mean, a credit default swap is essentially a derivative based on like a credit event, like a foreclosure. For instance, or should I say default, like I could sell you a credit default swap based on that GM is not going to pay this particular bond, or that GM is going to go bankrupt. And those are the sort of events that trigger around credit default swaps. A lot of the credit default swaps that were written by AIG were based on bonds in the subprime mortgage market and the mortgage market in general. So they would say, here's XXXY pool of subprime mortgage-backed securities. We're going to write a credit default swap against that.
You hate to use the term insurance because it's not insurance, but it was a way of
exactly. I mean, it's a way of
securing your asset.
You're trying to insure in the same way against a credit loss, which is different than saying.
It gives insurance a bad name, though.
Exactly, and I agree, and that's why you don't want to use mix the terms up too much. Certainly, AIG approached it as insurance. I mean, one of the reasons that AIG became, the largest writer of credit default swaps is because they felt like they had the insurance expertise. They felt like they had the tools. They felt like they could measure that risk. I think they felt like that if they could sell homeowners insurance, that they could sell, insurance based on losses in the credit and the mortgage market. Clearly, they were wrong. Right. So you saw so many of these sales done from AIG. There were a number of counterparties, and obviously one of the things that got talked a lot about the Fed was who were the counterparties. One of the reasons, and this has shifted, and I think this is one of the things that I think is troubling about the letting Lehman fail, bailing out AIG, bailing out Bear, is sometimes it's, depending on who you're talking to and how they feel that day, you get a different reason for why they did it. And I think we have yet to get some consistency out of Bernanke and Geithner and others. But the rationale at the time given for bailing out AIG was that if you didn't pay off counterparties to these credit default swaps, that the counterparties would themselves either fail or have to contract credit, and you'd have a spread of risk throughout the economy. And so you had to bail them out. Now, if you had gone into a bankruptcy situation, a bankruptcy judge would be able to say, well, you're not going to get fully paid, or you can't charge all the collateral. And it's worth noting that bankruptcy judges can disregard bonuses and rewrite contracts in that regard, depending on the rules of bankruptcy. There's a framework. Bankruptcy judges can't just do anything they want. But that said, you had to rush into AIG to make sure that the counterparties themselves were fine. We have since learned. Don Cohn, who's the retiring vice chair of the Fed, has come out and said that none of the counterparties were going to fail, but it seems that they didn't know that at the time, and they weren't sure that at the time. But there was a concern that would spread panic through the system if AIG was not bailed out.
I think it all it kind of begs the question about who should have been watching, and did our regulators let us all down? Were they not looking at Freddie Mac, Fannie Mae, AIG, all of these entities that have needed to be stabilized with the TARP money? Who missed it, and is there something we should be doing more than actually having people who enforce the securities laws?
Well, I think there are a couple of things that we certainly need to look at the broader questions in terms of how the bubble was created. And one of the things I think hasn't gotten enough discussion is monetary policy. We had, the federal funds rate for 3 years from 2002 to 2005 was negative. Right. The Fed was paying you to borrow money. To me, that's almost a recipe for a bubble developing in some regard. But there was a extent to which there was both a lack of power, but even a missing of the power that was there. For instance, a lot of the problem with the investment banks and even some of the larger commercial banks, where they had all these off-balance sheet entities that they were off-balance sheet in name, but the entities, the banks held the credit risk because of the backup lines of credit. The regulators knew about those, knew where they were at, and in a sense, these things were engineered to reduce the capital the banks would have to hold. And so the regulators basically just looked the other way. To some extent, the regulatory authority for Fannie and Freddie was always lacking, and you saw the most recent director of that office, and you saw, it took Congress years to put a new regulator in place, and by the time the new regulator in place put Freddie and Fannie, it didn't matter. The losses were already baked into the cake. So that's an area where I think powers were lacking, but in most of the other areas, the powers weren't there. And then there were some areas where they just weren't covered. For instance, AIG was regulated by the New York State Insurance Commissioner, but their derivatives and their CDS activity in London was not regulated by a U.S. regulator. So there are some gaps, but overall I would say it was a much bigger issue that the regulators just way underestimated the losses that were going to come from the housing market and did not act soon enough. They had sufficient power and basically just didn't act on it.
I talk about, you said earlier you don't believe that there's ever any hope of getting money back from Freddie Mac and Fannie Mae. Is that correct, or is there any hope there?
I would say there's no hope in terms of recovery. For instance, things have been sold recently from AIG that have recovered more than we thought they were going to make. Freddie and Fannie, there's not a hope that they'll just grow back when the housing market and they'll kind of be back in health again. There is hope in terms of when Congress turns to deciding what the future of Freddie and Fannie is. For instance, I'll mention we have other housing GSEs called Federal Home Loan Banks. Well, the Federal Home Loan Banks are still paying off what are called RevCore bonds that are paying us back for the S&L crisis. So to some extent, it would take an affirmative decision by Congress to say Freddie and Fannie or whoever their successor entities will pay us back. But in their current structure, we won't see a dime of it.
Getting back to TARP again, do you think there was enough oversight of Treasury as they expended these funds, or was it just basically you guys do whatever you want to do with the money and tell us about it later?
Well, one of the interesting things, I don't think there's any program where Congress tried to set up more external oversight. For instance, you had a special investigative IG set up. You had the Congressional Oversight Panel that was set up. You gave GAO special powers. But the point is that there's only so much oversight all these external entities can do if the statute itself is written in such a way that the Treasury Secretary feels he can do about anything. And there was incredible amount of flexibility written into the statute. There also was, we certainly heard a lot of early problems about the Treasury Secretary not necessarily working with the IG and letting them have information. So there's been certainly an effort by Treasury not to necessarily be cooperative. I'm sure they would make the argument that, we're putting fires out and we don't have time to respond to these audit inquiries, and there's certainly a rationale to that. But I would go back to say that there are tons of oversight mechanisms that were put into the statute. The problem is that the vagueness of the statute and the authority that it was granted was so broad that you could essentially drive a truck through it.
Well, it's all after the fact.
Exactly.
The money's out the door before you have any as far as real oversight or to know what they're doing. And
it really wasn't set up in a way to figure out how effective it was ever going to be. You didn't set up in a measurable way that we'd know what the what-if would be if you spent it some other way.
Okay. Well, I appreciate we're running out of time here, but I could go on talking about this for a long time. It's a huge issue, obviously, and has had great impact on the economy. But thank you very much for being with us. So. The Troubled Asset Relief Program put the taxpayers on the hook for a bailout of financial institutions that really, in many cases, contributed to the economic downturn. While Wall Street is on solid ground now, the American people are still experiencing high unemployment and a lot of uncertainty. I hope you enjoyed our discussion of the TARP today, and please tune in next time on the Congressional Report.
From the nation's capital in Washington, D.C., this has been the Congressional Report with Iowa Congressman Tom Latham. Have a question, comment, or concern? Congressman Latham wants to hear from you.